Every financial trap you'll face as your net worth grows. Rising net worth is often viewed as the ultimate solution to life's problems. However, wealth acts more like a magnifying glass than a shield. It amplifies both your opportunities and your vulnerabilities. As your balance sheet expands, the nature of the traps you face shifts from basic survival errors to sophisticated psychological and structural pitfalls. Understanding these traps is the difference between building a legacy and watching a lifetime of work evaporate. Wealth is a tool, not a destination. As your net worth grows, your primary job changes from earner to steward. Avoiding these traps requires more than just math. It requires a deep level of self-awareness and the discipline to remain boring when the world wants you to be flashy. Wealth can either be a bridge to the next generation's success or a wall that separates them from reality. Avoiding the legacy trap requires recognizing that your most valuable asset isn't your portfolio. It's the values and financial literacy you pass down before the money ever changes hands. Inheritors often receive significant sums of money, property, superannuation, trust assets, and even businesses without the context, financial literacy, or emotional framework to manage that wealth long-term. Preparing the next generation requires almost the opposite approach: collaborative planning, gradual responsibility transfer, and teaching rather than doing. You need to involve your children in complexity you've been protecting them from, share control you've worked hard to maintain, and prepare them for responsibilities they haven't yet earned.
Every financial trap you'll face as your net worth grows. Rising net worth is often viewed as the ultimate solution to life's problems. However, wealth acts more like a magnifying glass than a shield. It amplifies both your opportunities and your vulnerabilities. As your balance sheet expands, the nature of the traps you face shifts from basic survival errors to sophisticated psychological and structural pitfalls. Understanding these traps is the difference between building a legacy and watching a lifetime of work evaporate. The war within. Building a high net worth is often a game of external mechanics, math, markets, and labor. However, maintaining and enjoying that wealth is an internal war. As your bank account grows, your greatest adversary is no longer the economy or your competitors. It is your own evolved psychology. The war within refers to the cognitive biases, emotional triggers, and identity shifts that occur when survival is no longer the primary motivator. When you have enough, the brain, which is evolved for scarcity, starts to malfunction in an environment of abundance. The hedonic treadmill. The just a little more mirage. The most pervasive psychological trap is the hedonic treadmill. This is the tendency of humans to quickly return to a relatively stable level of happiness despite major positive or negative events. In a financial context, this manifests as the moving goalpost. When you earned $50,000, you thought $100,000 would make you rich. When you hit $100,000, your lifestyle adjusted, your peer group changed, and suddenly $250,000 became the new baseline for comfort. Why it's a trap? The dopamine hit. Every upgrade, a faster car, a larger home, first-class travel, provides a temporary spike in neurochemical satisfaction. The normalization. Within 6 months, the luxury becomes the standard. You no longer get a thrill from the upgrade, but you would feel immense pain if you had to downgrade. The exhaustion. You end up working harder to maintain a lifestyle that no longer brings you joy, simply to avoid the shame of moving backward. The identity-wealth fusion. As net worth grows, many individuals fall into the trap of equating self-worth with net worth. This is particularly common among entrepreneurs and high performers who sacrificed their 20s and 30s to build their fortune. When your identity is fused with your balance sheet, your emotional stability becomes a derivative of the stock market. If the market drops 10%, you don't just feel 10% poorer, you feel 10% less valuable as a human being. The symptoms of this trap: fragility. You become hypersensitive to criticism or perceived slights regarding your status. Risk aversion. Paradoxically, once you have wealth, you may become paralyzed by a loss. The fear of losing your status prevents you from making the very moves that helped you grow in the first place. Isolation. You begin to suspect that people only value you for your utility, your money or connections, rather than your personality, leading to a profound sense of loneliness. The comparison paradox, relative deprivation. Wealth is rarely measured in a vacuum. It is measured against one's peers. This is known as relative deprivation. A millionaire living in a middle-class neighborhood feels like a king. That same millionaire moving into a billionaire's row neighborhood suddenly feels impoverished. As your net worth grows, you naturally gravitate toward more exclusive circles. The trap is that there is always someone with a bigger boat, a faster plane, or a more diverse portfolio. The war within. This creates a poverty of spirit. You stop looking at how far you've come and focus exclusively on the gap between you and the person at the top. This drive can lead to return chasing, taking massive, unnecessary risks with a stable fortune just to catch up to a peer who is playing a completely different game. The complexity bias and the master of the universe fallacy. Success in one field often leads to cognitive overconfidence. If you're a world-class surgeon or a tech genius, you begin to believe your intelligence is domain general. You fall into the trap of thinking that because you mastered a complex field, you don't need to follow the boring rules of finance. This leads to the complexity trap, the belief that because you're wealthy, your investments should be complicated. How this manifests? Ignoring low-cost index funds in favor of exclusive hedge funds with 2% management fees, investing in tax-advantaged schemes that are borderline illegal or overly aggressive, buying into businesses you don't understand because you believe your Midas touch will save the venture. The sunk cost of toil. There is a psychological phenomenon where we value things more if we suffered for them. For the self-made wealthy, the war within often involves a refusal to stop working or to spend money because they're haunted by the scarcity mindset of their youth. Even with $20 million in the bank, an individual might spend 3 hours agonizing over a $200 flight difference or refuse to hire a personal assistant. This is the resource-time misalignment. They continue to trade their most limited resource, time, for their most abundant resource, money, because their brain is still wired for the survival phase of their life. The burden of preservation, the golden handcuffs. At a certain level of wealth, the psychology shifts from creation to protection. This creates a persistent underlying anxiety. When you have nothing to lose. When you have a high net worth, you become a target for lawsuits, for family members asking for money, for inflation, and for market crashes. This stewardship anxiety can lead to decision paralysis, being so afraid of making a mistake that you do nothing, allowing inflation to eat your purchasing power. Hypervigilance, spending hours every day checking tickers and news feeds, effectively becoming a slave to your own wealth. Winning the war. The only way to avoid these psychological traps is to define enough before you get there. Without a predefined exit ramp for your desires, your ego will simply move the goalposts for eternity. Wealth should provide 3 things: autonomy, security, and impact. If your net worth is growing, but your stress is increasing, your autonomy is shrinking, and your relationships are fraying, you're not winning the war. You are falling into the trap. The ultimate victory in the war within is achieving a state where your money serves your life rather than your life serving your money. The hedonic treadmill and lifestyle creep. The most common trap is the invisible expansion of needs. At a lower net worth, a $5,000 watch seems absurd. As wealth grows, it becomes a standard reward for a good quarter. This is lifestyle creep. If your expenses rise in perfect lockstep with your income, your freedom remains a mirage. You're not wealthier, you're just a more expensive version of your former self. The expert fallacy. Success in one domain, like the stock market or content creation, often breeds a dangerous overconfidence in others. High net worth individuals frequently fall into the trap of believing that because they mastered how to make money, they are naturally gifted at how to manage it. This leads to ignoring professional advice or taking uncalculated risks in sectors they don't understand, such as complex commercial real estate or niche startups. The isolation of wealth. As your net worth climbs, your peer group changes. You may find yourself surrounded by people who are also high earners. This creates a skewed reality where having 5 million feels like struggling because your neighbor has 50 million. This social comparison can drive you to take unnecessary risks to keep up, destroying the very security you worked to build.
This is our second topic where we can learn and understand about the investment traps. 1. The complexity mirage, sophistication as a status symbol. 2. The private equity and venture capital siren song. 3. The yield trap, the hunt for income. 4. The concentration mirage, the golden goose fallacy. 5. The tax alpha mirage. 6. The alternative asset rabbit hole. The investment traps, chasing the mirage. The complexity trap. Wall Street and private equity firms love high net worth individuals. Why? Because they can sell them complexity. You will be offered exclusive hedge funds, structured products, and private placements with high fees and black box strategies. Often, these products underperform a simple, low-cost index fund after fees are accounted for. Remember, complexity is a cost, simplicity is a hedge. The concentration trap. What got you to wealth is rarely what keeps you there. If you built your net worth through a single stock, a specific commodity like gold, or a single business, you have a concentration risk. The trap is falling in love with the asset that made you rich. Markets shift, and geopolitical events can turn a sure thing into a liability overnight. True wealth preservation requires the discipline to diversify, even when it feels like you're selling your winners. Chasing alpha at the expense of beta. When you have $10,000, a 20% return is great, but not life-changing. When you have $10 million, a 20% return is $2 million. The trap is continuing to swing for the fences. As net worth grows, the goal should shift from return on capital to return of capital. Chasing high-yield moonshots with a large portfolio often leads to catastrophic drawdowns that take years to recover from. When your net worth crosses certain thresholds, your relationship with investing must undergo a fundamental shift. You move from the accumulation phase, where the goal is to grow a small pile of money into a large one, to the preservation and optimization phase, where the goal is to keep what you have while generating sustainable returns. However, the financial industry is designed to exploit the psychology of the newly wealthy. Here is a deep dive into the mirages that lead even the smartest investors into expensive traps. 1. The complexity mirage. Sophistication as a status symbol. The most pervasive trap is the belief that as you become wealthier, your investments should become more complex. This is often fueled by private wealth managers who want to justify high management fees. The trap is you are offered structured products, principal-protected notes, or black box hedge funds. These products use derivatives to hedge risk, but they come with layers of embedded fees, sometimes exceeding 3 to 5% annually, and lack transparency. The mirage, the investor feels like an insider because they're buying something the general public cannot access. The reality, in most cases, a simple 3-index portfolio, total stock market, international stock, and bonds, outperforms these complex vehicles over a 10-year horizon after taxes and fees. Complexity is a feature for the seller, but a bug for the buyer. 2. The private equity and venture capital siren song. As your net worth grows, you will likely be invited to join angel groups or invest in private equity, PE. The trap is investing in the next Uber or a local real estate development. The trap here is twofold: illiquidity and adverse selection. Illiquidity. Your money is locked up for 7 to 10 years. If you have a personal emergency or the market crashes, you cannot sell these shares to raise cash. Adverse selection. The very best deals, the top-tier VC firms, usually don't need your money. They have institutional backers. If a deal is reaching an individual with $2 million or $5 million, it's often because the smart money already passed on it. The mirage is the hope of a 10x or a 100x return that will catapult you to the next level of wealth. The reality, most startups fail, and most PE funds struggle to beat the S&P 500 once you account for the carry, the performance fees, and the fact that your capital was tied up and unusable for a decade. 3. The yield trap, the hunt for income. In a low-interest rate environment, wealthy individuals often feel cheated by the 1 to 4% yields offered by high-quality bonds or savings accounts. The trap is moving out the risk curve to find higher yields. This leads investors towards junk bonds, high-yield REITs, or private credit. The mirage is a safe 8 to 10% annual distribution that feels like a salary. The reality, high yield is almost always a compensation for high risk. When the economy hits a snag, these income investments are the first to default. Investors often forget that principal protection is more important than yield once you have already won the game. 4. The concentration mirage, the golden goose fallacy. Most people get wealthy by being concentrated, owning one business, one piece of real estate, or a large block of stock in the company where they worked. The trap is the psychological inability to diversify. This is known as loyalty bias. You feel that because Company X made you $5 million, it is disloyal or unwise to sell it. The reality is that concentration builds wealth, but diversification preserves it. External shocks, like regulatory changes, technological disruption, or a global pandemic, do not care about your expertise. A 50% drop in a concentrated position is a permanent loss of lifestyle. A 50% drop in 1/10 of your portfolio is a temporary setback. 5. The tax alpha mirage. As you move into higher tax brackets, you become obsessed with tax-loss harvesting and tax-advantaged schemes. The trap is making an investment decision solely for the tax benefit. This often manifests in buying opportunity zone funds or certain types of insurance products like private placement life insurance that have high internal costs. The mirage is feeling like you are beating the government. The reality, a bad investment that saves you $50,000 in taxes but loses $100,000 in principal is still a $50,000 net loss. Never let the tax tail wag the investment dog. The goal is to maximize net after-tax wealth, not to minimize taxes paid. 5. The alternative asset rabbit hole. From art and wine to crypto and watches, alternatives are the new frontier for the wealthy. The trap is treating collectibles or speculative assets as a core pillar of a portfolio. These markets are highly unregulated, have massive bid-ask spreads, it costs a lot to buy and a lot to sell, and zero intrinsic cash flow. The mirage is diversification. If the stock market crashes, my Rolex collection or Basquiat print will hold its value. The reality, in a liquidity crisis, all correlated assets tend to drop together. People sell their alternatives to cover margin calls on their core investments, causing the price of luxury goods to crater exactly when you need them to be stable. Summary: how to avoid the mirage. To navigate these traps, an investor must adopt a margin of safety mindset.
As your net worth grows, your strategy should move towards lowering costs, increasing liquidity, ensuring you always have dry powder, cash, to take advantage of genuine opportunities when others are panicking. Simplifying structures. If you can't see the underlying assets or understand how the manager gets paid, walk away. Ruthless diversification. Protecting against the unknown unknowns.
This is our third topic, where we can learn and understand about the structural traps. 1. The tax inefficiency trap. 2. The liquidity to net worth mismatch. 3. The expert fee creep. 4. The complexity and maintenance trap. 5. The friend and family venture capital trap. 6. Liquidity constraints.
The structural traps, the hidden leaks. The structural traps of growing net worth are the most dangerous because they are often invisible. Unlike a bad stock pick, which shows up as a red line on your brokerage statement, structural leaks are the silent friction that erodes your wealth through the plumbing of the financial system itself. As your net worth climbs, you stop being a simple saver and become a portfolio manager, whether you realize it or not. Here are the primary structural leaks that can drain even the most successful individuals. 1. The tax inefficiency trap. For most people, the largest lifetime expense isn't a house or a car, it's taxes. At a lower income, tax planning is straightforward. As you enter higher brackets, every dollar of growth is subject to a complex web of capital gains, dividends, and ordinary income taxes. The trap is focusing on gross returns instead of net after-tax returns. A fund that returns 12% but is tax-dragged by high turnover, frequent trading, might actually leave you with less money than a boring index fund returning 9%. If you aren't utilizing tax loss harvesting, asset location, placing tax-heavy assets in sheltered accounts, and stepped-up basis strategies, you're essentially giving the government a massive, interest-free portion of your hard work. The liquidity to net worth mismatch. There is a massive difference between being rich and being liquid. As net worth grows, people tend to lock their capital into illiquid buckets, private equity, real estate, art, or a primary business. The trap occurs when a life emergency or a market crash happens. If 90% of your wealth is in a commercial building you can't sell for 6 months, you are forced to take high-interest loans or sell your few liquid assets, like stocks, at the worst possible time, the bottom of a market. This forced selling is how many multimillionaires go broke during recessions. The expert fee creep. As your wealth grows, a small army of professionals, lawyers, accountants, wealth managers, and insurance brokers will offer their services. While these are necessary, their fees are often structured as a percentage of your total assets, AUM. A 1% management fee sounds small, but over 30 years it can consume nearly 1/3 of your total potential wealth due to the loss of compounding. This is a structural leak that compounds against you. If your advisors aren't providing value that exceeds their cost, they are a leak that needs to be plugged. The complexity and maintenance trap. Wealth creates stuff, and stuff requires maintenance. Every new property, LLC, or sophisticated investment vehicle adds a layer of administrative overhead. You end up paying for specialized tax filings, property managers, and legal compliance. The trap is that complexity does not scale linearly, it scales exponentially. Eventually, the time and money spent managing the structure of your wealth can begin to outweigh the utility the wealth provides. How to plug the leaks. Audit your take-home. Track your net worth based on what stays in your pocket after taxes and fees. Maintain a liquidity ratio. Ensure at least 15 to 20% of your net worth is accessible within 72 hours. Simplify the structure. Before adding a new entity or account, ask if the marginal benefit outweighs the lifetime maintenance cost. The tax inefficiency trap. As your income increases, the government becomes your most significant business partner. Failing to optimize for tax efficiency is a silent wealth killer. Many people focus on gross returns rather than net after-tax returns. Without proper estate planning and tax-advantage structures, you could lose 30 to 50% of your wealth's growth potential over time. The friend and family venture capital trap. Success makes you a target for every great idea from people you know. You will be asked for loans, seed capital for restaurants, or bailouts for struggling relatives. The trap isn't just the money lost, it's the emotional debt and the destruction of relationships. Wealth requires the ability to say no firmly and often. Liquidity constraints. Net worth is a paper number. Liquidity is reality. A common trap for growing wealth is becoming asset-rich and cash-poor. If 90% of your wealth is tied up in illiquid real estate or private business equity, a sudden market downturn or personal emergency can force you to sell assets at a massive discount.
This is our fourth topic, where we can learn and understand about the legacy traps. 1. The aspiration eraser, influenza. 2. The communication vacuum. 3. The gilded cage, control via capital. 4. The complexity of fairness versus equality. 5. The easy street trap for heirs. And 6. The lack of an estate roadmap. The legacy traps, wealth versus family. When your net worth climbs, the most complex challenges shift from the balance sheet to the dinner table. The legacy trap is the paradox where the financial security you built to protect your family becomes the very thing that destabilizes it. As wealth grows, the friction between preserving capital and nurturing character creates 3 primary pitfalls. 1. The aspiration erasure, influenza. The most common trap is removing the necessary struggle for the next generation. Wealthy parents often want to give their children the things they never had, forgetting that the struggle to get those things is exactly what built their own resilience and work ethic. The risk: providing an effortless lifestyle can lead to failure to launch syndrome. When a young adult has their housing, travel, and basic needs subsidized indefinitely, the internal drive to innovate or compete in the marketplace often evaporates. The fix: shift the focus from giving money to giving opportunity. Fund education and entrepreneurship, but let the daily lifestyle remain the child's responsibility. 2. The communication vacuum. Many high net worth individuals treat their estate plan like a state secret. They fear that if their children know how much they will inherit, they will stop working. However, silence creates a lottery ticket mentality. The risk: heirs who are surprised by a sudden windfall are statistically likely to lose it within 3 years. Without a financial apprenticeship, they lack the emotional and technical muscles to manage millions. The fix: practice radical transparency. Gradually involve older children in family office meetings or philanthropic decisions to normalize the presence of wealth. 3. The gilded cage, control via capital. Wealth is frequently used, consciously or subconsciously, as a tool of manipulation. This is the trap of attaching invisible strings to financial gifts, such as dictates on career paths, marriage partners, or lifestyle choices. The risk: this breeds resentment and dependency. It stunts the heir's emotional maturity, as they never truly feel like independent agents of their own lives. They become custodians of their parents' expectations rather than individuals. 4. The complexity of fairness versus equality. The final trap is the assumption that a 50-50 split of assets is always the best path. The risk: if one child is a surgeon and the other is a struggling artist, or if one child is active in the family business and the other is not, an equal split can spark decades of litigation and family feuds.
Leaving a complex business to 3 siblings who don't get along is a recipe for a legacy fire. The fix: define legacy by impact rather than equivalence. Use trusts to protect assets and ensure that the distribution reflects the reality of each heir's situation. The easy street trap for heirs. One of the greatest fears for wealthy parents is affluenza, the loss of ambition in their children. Providing too much too soon can rob the next generation of the struggle that builds character. The trap is thinking that leaving a massive inheritance is an act of love, when, without financial education, it may be an act of destruction. The lack of an estate plan. Many wealthy individuals delay estate planning because it forces them to confront their mortality. The trap is leaving a mess. Without a clear will, power of attorney, and trust structures, your wealth will be tied up in probate courts for years, with a significant portion going to legal fees instead of your beneficiaries. Moving forward, wealth is a tool, not a destination. As your net worth grows, your primary job changes from earner to steward. Avoiding these traps requires more than just math. It requires a deep level of self-awareness and the discipline to remain boring when the world wants you to be flashy. Wealth can either be a bridge to the next generation's success or a wall that separates them from reality. Avoiding the legacy trap requires recognizing that your most valuable asset isn't your portfolio. It's the values and financial literacy you pass down before the money ever changes hands.